welcome to PQ Prime. I'm Hiral Daria. Joining us on the show today to discuss what it means, on last day of expiry from a fundamental perspective and the stocks that are moving. We have Pankaj Pandey, Head of Research at ICICI Direct, joining in. Welcome to the show, Pankaj, and a very good morning.
Hi, good morning here.
Right. Pankaj, to start off with, firstly, if you see in terms of markets, we have seen a positive opening, a lot of positivity that's coming in from the auto majors as well, like a Hero Moto, Aisha Motors. These are a few of the names which are trading in the positive. And we are just a day or two away from the auto sales numbers that will start trickling in for the month of March as well. What's your view, and is this a rally ahead of the numbers in anticipation of a good March?
So on the market overall, market has been sort of forming a base around 16,800 to 17,200 kind of a level. So unless Nifty closes or trades about 17,200, I think we cannot really say a decisive trend for a change. Now, coming specific to autos, obviously in the auto space, monthly volumes are expected over the weekend, and overall, our sense is that the volume prints are going to be healthy for March, given the fact that this is the last month for BS6 stage 2 transitioning. And we all know that the vehicle prices are expected to go up by 2 to 5%. Within auto, we expect that CV and PV space to sort of do relatively better, so which is where I think Ashok Leyland and Tata Motors are expected to sort of outperform. I think one more positive could be that margin recovery we have seen for most of the OEMs last quarter, and probably even this quarter also we would see margin recovery sort of panning out, because we've seen crude derivatives, including plastics, so they've sort of come down, while rubber prices are sort of slightly higher. But overall, we would expect even margin recovery to sort of find favor. And which is why I feel that companies like, say, Maruti, which has an ambition of gaining market share, especially on the because of the EV launch, should benefit. Then Tata Motors and Ashok Leyland are the other two picks with a target price of 530 and 185.
Right, so that's with regards to where auto stocks are concerned. Moving on, you have sugar packers in focus as well. Firstly, there were concerns with regards to where output goes, and it seems output in Brazil as well as India is expected to be lower. With that, if you see in terms of the global price trend as well, what's your view overall with regards to sugar stocks, and do you have any buy recommendations there?
So here in sugar, the earlier expectation was that we will have a production of about 24 million tons. But now it is coming, or it looks like that we will have a lower production of somewhere about 32.5 million tons. What it does is that if you have already sort of contracted for export of 6.3 million tons, so inventory levels are expected to sort of come down by 1.5%. Now, there is also a possibility of El Nino sort of panning out this year, and we have seen that whenever that happens, especially it is positive for UP-based sugar mills, because there the water table is higher, whereas the millers in the Karnataka and Maharashtra get impacted. Now, all of it, our sense is that is going to sort of buoy the sugar prices by 2 to 3 rupees. So our sense is that the sugar prices can inch up to 37, 38 odd rupees, and which is a sort of a positive point for select UP-based companies. What we prefer is something like Dalmia Bharat Sugar, Dhampur Sugar. I think these companies have seen a slightly better recovery rate. So Dhampur Sugar with a target price of 270 and Dalmia with a target price of 490. I think would be the preferred stocks in sugar space.
Right. So that's with regards to where sugar companies are concerned. Moving on, if you see in terms of cement players as well, we are seeing some bit of movement over the last couple of trading sessions with cement as a pack as well. A lot of order wins coming in, in terms of infra companies, for infra companies, and the budget allocation also has been pretty strong. What would you recommend to do with cement majors?
So I think in cement, things are sort of turning up quite interesting. So previously, we sort of mid-Feb, the companies had attempted a price hike of 10 to 15 rupees per bag. But that had to be sort of rolled back. But our sense is that in the month of April, as per our channel checks, probably we are looking at, or probably we might see an announcement of 10 to 30 rupees kind of a price hike. And so that's a sort of a big positive, because what our sense is that overall margin recovery is expected for cement companies in Q4, because When you look at the coal prices, especially the South African imported coal prices, they are down about 30 odd percent. So that should sort of provide a leg up of to the tune of 150 to 200 rupees per ton on a EBITDA basis for most of the cement companies. And if on top of it, if the companies are able to take a price hike of say 10 to 30 rupees per bag, probably it will sort of improve the EBITDA ton by about another
Mm.
150 to 200 rupees per ton. Probably that will happen after Q1, but I think this is a sort of positive thing, given the fact that, like you highlighted, the government has been sort of focusing more on capex. So, which is why we feel that probably this is one space which can do well. So, what we prefer is tier one players like say Ultratech, where our target price is about 8,050 now. This company is one company where you are not going to see aggressive capacity expansion. They are looking to ramp up capacities at 7%. They are very conscious of IRR being 15%. So, which is why we also like a smaller company like say Sagar Cement. This stock has seen a decent correction, but our sense is that it's available at $50 EV per ton, a 10 million ton kind of a capacity.
Mm.
Here our target price is 250, and they are expanding to central and eastern regions. So which is where our sense is that the demand outlook is a lot better. So I think these are the two largely picks which are sort of coming out in the cement space.
Right. Moving on, Pankaj, Reliance Industries is another stock to focus on. After the stock hit a 52-week low, a lot of brokerages have gone positive from a valuation perspective, with value unlocking that could be coming in for shareholders as well. Because clearly in the 2019 AGM as well, it was indicated that in the next 5 years we will see, listing of a lot of entities within as well. Overall, what would your view be on a Reliance Industries, and do you think this is a good time to enter the stock?
Absolutely. I think the Reliance has seen a decent amount of correction. I think they have a number of triggers in place. So for example, we all know that they've sort of taken entry into FMCG space. Earlier, they were largely focusing on their modern trade network, but now they are sort of looking at general trade network, and their pricing is looking sort of quite aggressive with 30 to 50% kind of a discount being offered. So obviously, it's a sort of a thing, a negative for a lot of existing FMCG companies. But for Reliance, definitely it is a positive. And I think even when you look at on the Geo front, the company has announced fresh packs for Geo Fiber Plus. Even for the upcoming season, they have come up with a especially prepaid recharge. Now, thing is that we all know that voice is something which is typically free, but data is where overall user spends some or consumes about 25 GB kind of a data. I think that number can potentially double in the next 3 4 years, and I think events like IPL are sort of are triggers for that. And which is why I feel that this company, given the fact that they are going to sort of be a pan India 5G player by December 23, I think that should sort of provide leg up to their ARPUs and EBITDA. So I think so, which is why we like Reliance with a target price of 3050.
Right. So that's with regards to where Reliance Industries go. Moving on, you have South Indian Bank has but the stock is under pressure in today's session, and this is because the MD and CEO will not be reappointed due to personal reasons. How would you view a South Indian Bank from a fundamental perspective, and with uncertainty in terms of the leadership team? What would you have to say?
So I think the previous MD was appointed in somewhere in September 20, and I think that had a big positive rub off on the stock because that led to a lot of fundamental improvement. So NIMs actually improved from say 2.6% to 3.5%. Then the PCR also sort of improved to about 60 odd percent. And as a result of that, we have seen a pretty sharp run up in the prices because the valuations has also sort of inched up from 0.3 time price to book to about 0.65. Now, if the performing MD is sort of not looking for an extension, obviously it is going to sort of put clouds in terms of the growth prospects until you get the new MD, and which is why I feel that probably stock could trade at about half time book. So probably till the time you don't get an MD, and till that time the stock is probably going to languish.
Okay, so that's with regards to South Indian Bank. Moving to a DCB, what's your view? Because if you see in terms of DCB as well, I think if I'm not mistaken, they have done some fundraise as well. And if you see in terms of today's session, the stock is down around 3.5%.
Correct. While it might be up, but when you sort of look at, we have seen a decent amount of correction in the stock because, see, from a number perspective, they've been delivering strong credit growth of about 21%. There has been an NIM expansion to about 14 odd bips. And the overall valuation is also sort of attractive at about 0.7 times. Now the challenge is that the management is talking about doubling the balance sheet in the next 3-4 years, and that would require investing in building or putting money in business infrastructure. Now, something similar they've done in the past, and the challenge is that when you're going to sort of invest so much, probably your ROA trajectory of 1%, you don't really get comfort there. The management will be able to achieve ROA trajectory of 1%. So, which is where, while it might be up, but this is not one of the best banks to sort of look at in the tier two private bank category. I think what we would prefer is more of a federal bank. So from that perspective, I think DCB probably may not really go back to these previous levels of 140. That is what our sense would be.
Right. So that's with regards to DCB, but a federal preferred over a DCB, as Pankaj is mentioning. Moving on, Pankaj, Shalby is up around 8.5%, and they have seen an allotment of preference shares by Mars Medical. What's your view on a Shalby?
So we like the hospital as an entire space. One, I think there is a number of structural shifts happening. So I think payer mix is largely going to change towards higher insurance. Then I think what you're also seeing is that there has been a lot of bed addition in the last 4-5 years in the tier 2, tier 3. And occupancies have improved from 57 to 62 odd percent. RPOBs have moved up from say 34, 35 to 45,000 rupees. Now, so overall, our sense is that most of your hospitals will deliver, say, 14 to 15% CAGR kind of a top line and a higher bottom line kind of a growth. And Shalby, when you sort of come to specific, here our target price is about 180. Now, this company is trading at literally half of the valuation for some of the tier one names. But our sense is that this company has achieved a critical mass in the joint replacement. So they've got a 15% market share. And now they are moving into some of the other specialties like cardiac, neuro, oncology. And largely that will be sort of a satellite model what they would follow. So from that perspective, I think attractive valuations part and also moving to newer specialities, I think augurs well for the company. So we like this stock, like I said, with a target price of 180.
Right. And very lastly, what's your view on the Jindal Stainless? They bought 49% in Indonesia nickel smelter for $157 million. What's your view on the stock, and do you think it's a good buy?
So I think within metal space, this is one of the few good companies to look at. Here our target price is 300. Now nickel is a very volatile commodity and is a significant cost component for any stainless steel player. Now, for JSL specifically, our sense is that overall they are clocking somewhere about 19,000 rupees EBITDA per ton. And for next year, overall, our sense is that the volume growth could be about 20%. So from 1.7 million ton to about 2.4, 2.5 million tons is what we are expecting, and with better EBITDA per ton. Now, when you're sort of looking to sort of do a backward integration, which will benefit beyond FY25, I think the margin volatility is going to be a lot more lower. And which is why I feel that it's a sort of a very structural capex what the company is looking to do. So we like this company with a target price of 300. So I think things are moving in the right direction for this.
Right. So these are few stocks one should be watching out for as well. Thank you, Pankaj, so much for joining us on the show and sharing your views with our viewers as well. Thank you. Stay safe and speak to you soon again.
Thank you so much. Bye.